Do you want to learn how to make money while you sleep? In today's video, I will be discussing everything you need to know about dividend growth investing. I will go over what it is, how to do it, and the pros and cons of it. What's up, you guys? My name is Alex Sanchez, and this channel is focused on growing your knowledge in personal finance. Investing in dividend stocks. Everybody begins the same way when they start earning. That is, they burn through human capital, also known as life and time, to get money in return. Now, what you do with that money decides how your future life will be. Be careless with money and you will be working for the money your entire life. Be smart with money, and at some point in your life, you will not have to work for money again. Smart people understand how to create passive sources of income with their current sources of income. Those passive sources could be your intelligent investments or self-running businesses. While setting up a business does require quite a bit of effort, an intelligent investment doesn't take anything more than your capital and a little bit of research. If you're looking for that intelligent investment to build yourself a source of regular passive income, look no further than dividend stocks. What is it, dividend stock investing? As a common stock investor, you can make money mainly in two different ways. First, when the stock you buy increases in price or in value, and second, when the company pays you dividends. Figuring out which stock will increase in price is quite an art that can be learned if you're willing to put in some time and a little bit of effort, while figuring out stocks for dividend investing can be relatively easier. Many corporations, big and small, share a part of their earnings with their shareholders, which we call dividends. If the businesses under these corporations are strong and they throw out a lot of cash year after year, these corporations may keep on paying increasing dividends year after year. In dividend stock investing, we look for such businesses, we buy them and keep them for long periods of time to receive regular dividend payouts. Dividend stock investing not only gives you a regular stream of cash flow, but also keeps you invested in quality common stocks, which can ultimately help you reap benefits of long-term common stock investing in the form of capital gains. So if you're invested in good blue chip stocks, you should be able to receive both benefits of owning stocks. How dividend stock investing works is there's four factors. These four factors are what a lot of dividend stock investors look for in dividend stocks. These investors create a portfolio of companies that 1. Have a long history of dividend payments, 2. Have strong businesses, 3. Pay a good share of their net income in dividends, also known as payout ratio, and 4. Have decent dividend yields, and that's dividends per share as a percentage of the stock price. And for extra credit, factor number 5 is that they smash the like button to help out this channel. I know you're appreciating that smooth plugin, but hopefully you did it. Let's unpack these factors a little bit. A good dividend stock has good history of dividend payments. That means companies with a consistent track record of increased dividend payments. A track record of at least 10 years and an average annual dividend growth of 6% should be good and a safe investment to look at investing in. Factor number 2, strong businesses. These are strong debt-free businesses that are great franchises, leaders, monopolies, duopolies, and annuity businesses that generate high disposable cash. These businesses do not require much in capital investments to sustain their leadership and growth. Such businesses can continue to pay increasing dividends year after year without impacting their business competitiveness. Factor number 3 and 4, payout ratios and dividend yield. Your ideal stock can have a payout ratio between 40 to 80% and a dividend yield between 3 to 5%. You should closely scrutinize the companies that have extremely high payout ratios, for example, over 80%, or very high dividend yield, for example, over 5%. High payout ratios or yields may be associated with dying businesses, which may be paying dividends currently, but their ability to pay dividends may get impacted because the business might be losing its sheen. This criterion does have a fair share of subjectivity, and you must use your best judgment when you stumble upon such situations. Investors can also pick dividend ETFs that have underlying portfolios created with the same philosophy that we laid out above. ETFs are way simpler and more convenient because investors don't have to track individual stocks. Most importantly, they save investors time and effort. One thing about ETFs is they do come at a nominal cost, meaning they have an expense ratio of about 0.5%, if not less, but the benefits far outweigh the costs for investors who know nothing about stocks and for the ones who can't devote a lot of time to this part of their life. Once you are done creating portfolios or buying ETFs using the above parameters, you then decide on what you will do with the dividends. You can cash these dividends out and use them the way you want it, perhaps as spending money, or reinvest them in the same basket of stocks that you currently own for the compounding effect of your returns. And for those of you who don't know what compounding interest is, there's a famous quote by Albert Einstein that goes like this: "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." So basically, compound interest is what accelerates your journey to building wealth with long-term investing. Now, obviously, cashing out makes more sense for retired people who need a source of income to survive, while reinvesting is for the ones who are still in their working age and accumulating their retirement fund. Pros and cons of dividend investing. Pro number one, they're easy to choose. Dividend stocks are easier to choose than choosing stocks based on other strategies, for example, growth stocks. You can use online tools to filter the universe of stocks for their dividend yield, perform some basic research on the businesses, and start investing in them. Pro number two is you get regular payments. Once you have chosen a portfolio of companies with strong businesses and growing dividends, you can confidently assume a regular stream of cash payments and dividends. Pro number three is there's lower taxes. The qualified dividends are treated favorably from tax perspective and are taxed at lower capital gains tax rate. Dividend becomes qualified for tax purposes when the stock is held for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date which you need to buy shares to be eligible for dividend. Assuming you're investing in dividend stocks for a long-term horizon, you will almost always be eligible for the tax benefits. Cons. Some of the cons, on the other hand, are the average returns. Dividend investing may lag returns of some high return asset classes. One shouldn't expect more than 4% in dividend yield while investing in dividend stocks. These returns, however, are decent enough for an investor with a moderate risk profile and a long-term horizon. If you're looking for higher returns, that's when you focus on value growth investing, but that requires more due diligence and sometimes higher volatility and risk. To each their own. Con number two is market exposure. Speaking of volatility, because you will be buying common stocks, your portfolio will be susceptible to volatile market movements. However, this shouldn't bother a long-term investor who has chosen his portfolio of stocks wisely. How to start dividend investing. To start dividend investing, you first need to decide between direct investing and ETF investing. If you want to go the direct investing way, you need a brokerage account. Once you have a brokerage account in place, such as Robinhood, which I use, you can use online tools to do the necessary research, pick your stocks, invest in them, and then keep adding funds till the time you reach your desired objective. If you want to go the ETF way, you have many dividend ETFs you can invest in, like Vanguard High Dividend Yield ETF, also known as VYM. Perform your checks on the ETFs the same way you would do on stocks as described earlier in this post. Check for the 5-year and 10-year return of the ETF to have a sense of its history of returns and get a reasonable sense of how well the ETF or stock is. Dividend stock investing might not make sense to you when you start with a small capital and the received dividends are even smaller. But when you think about it from the perspective of long-term compounding interest, it opens up a whole new world to you. Once you develop an autopilot dividend investing strategy, your investment keeps growing. That's done so with your contributions, your periodic payouts, which can then be put to work to further expand your investment. You also get increased payouts because your investment keeps growing like a snowball does so. And lastly, the stocks and ETFs in your portfolio also see capital appreciation over time, assuming it's a good company or ETF to be invested in. Once you put all this together and keep investing, even for a moderately long period of time, you can reap huge benefits out of dividend stock investing and eventually have your money work harder than you do. For those of you who want to know, I invest using the Robinhood app, and if you guys want to start as well, Robinhood will be giving you a free stock valued anywhere between $2 and $200 once you sign up to invest with their platform. More info in the description below. Thank you guys so much if you have made it to the end of this video, and I will see you guys in the next one.